Hey guys, Daniel here with Value Investing with Daniel. Thank you for tuning into this video. This is lesson number 5 in the value investing course that I'm putting together. And this video is about the sort of companies that we don't want. So it's important to know what to look for in a company right off the bat as your initial screen so you can determine the sort of companies that you don't want to be invested in. As modern value investors, we are in it for the long run, meaning we are looking to buy wonderful companies at good prices. Wonderful companies at good prices. So in order to make an investment, it has to meet those two criteria. Wonderful companies at good prices. But obviously, with each of those, the wonderful company and the good price, there are multiple category checklist that we need to meet in terms of the criteria in order to justify the investment. If you watch the previous videos, which I encourage you to do in this course, such as, what wonderful companies are, what good prices are, then you'll get a good foundation for this video. So we need to ask ourselves, what are the sort of companies that we don't want? Generally speaking, we are trying to avoid companies in very cyclical, commodity type businesses that in terms of their competitors don't really have any sort of dominant competitive advantage. So what we're trying to avoid are companies with no competitive advantage. Okay, typically speaking, these are going to be companies like in the airline business, okay, oil and gas companies generally, automobile companies like Ford or General Motors. These companies do not have any sort of competitive advantage and as a result don't have really good pricing power. And so they have to basically sell their products or services based on what the competition is selling them for. Okay, so we're trying to avoid commodity type businesses, right? And when I say commodity type businesses, I basically am referring to any company that doesn't have some sort of distinct competitive advantage compared to its competitors. And and like I say, those are going to be the automobile companies, like Ford or General Motors, like I mentioned. It's going to be the oil and gas companies. Okay, it's going to be lumber companies, any sort of basic materials. Those are the industries or sectors that we're trying to avoid pretty much altogether because the companies, unless they're extremely dirt cheap in terms of their valuations, they're almost never going to be a good investment. So we exclusively want wonderful companies with some sort of sustainable competitive advantage. And right off the bat, that almost will always eliminate all the basic material companies, the automobile companies, the airline companies, the oil and gas companies. And that'll happen basically right off the bat because those companies basically just don't have any sort of competitive advantage. I'll give you an example of what I mean. Let's go to Yahoo Finance here. Now we can see some companies here that do have a sort of competitive advantage, like Microsoft, Apple, Amazon, Google, Meta, Intel. Arguably, these are companies that do have competitive advantages. But if we want to look for companies that don't, we can see something like, for example, Ford. Ford is a company that doesn't have any sort of competitive advantage. General Motors as well. And ways of identifying companies that don't have competitive advantages typically come through a couple of very easy screens that you can do. The first indication that a company does not have any sort of competitive advantage is it doesn't make money. So if a company has a competitive advantage, it should be able to make money, should be able to make a lot of money in terms of earnings and free cash flow. As we can see with Ford, in 2020, although a lot of companies lost money in 2020, it didn't make any money. In 2019, it barely made any money. Like $47 million is a complete joke for a company pulling in $156 billion a year. I mean, that is really pathetic. So, this is just something that you can do extremely quickly to be able to see if a company has a competitive advantage. It will have earnings and revenue consistency and growth, okay, and free cash flow consistency and growth. Companies with a distinct and sustainable competitive advantage will make a lot of money every year, year after year. Let's use a company like Meta, which has a sustainable competitive advantage, okay? It makes lots of money and lots of revenues and grows them almost consistently year after year. Now, we're only looking back 4 years here, but you get what I'm saying. If a company has a competitive advantage, it will make more money every single year, okay? More or less, in terms of revenues, earnings, and free cash flows. companies that don't have a competitive advantage, that just sell basically a product like anything else, like any sort of lumber company, like I can't, I got a, like any sort of timber company like this, West Fraser, sorry, I didn't know how to spell Fraser, but West Fraser, okay, a company like this basically, you know, does not have any sort of earnings or revenue consistency and growth. And as a result, basically, that is the first thing that you can do to look for any sort of competitive advantage. Because if it did, it would make more money every year, and it would make more earnings and more free cash flow year after year. The other thing that you can look for is the debt position. Companies without a competitive advantage typically have to borrow a lot of money. So if you go to statistics and you look at the total debt that the company has, if it has a lot of debt, like look at this, Ford has $130 billion worth of debt. Companies without a competitive advantage almost always need to borrow a lot of debt. Companies with a competitive advantage don't. So if we look at Ford, for example, it has $130 billion worth of debt, okay? You subtract out this cash, it has $100 billion net debt. In terms of its earnings, okay, at its current earnings, it would take basically, you know, almost 10 years for it to pay off its debt, more than 10 years. So that is an indication that it does not have some sort of competitive advantage. If we compare this now to, let's say, Meta, okay, Meta, now I'm not saying it's a perfect company, but look at its debt. It has more cash and debt. It could pay off all its debt instantly if it wanted to, basically. Right? So just those two things there, revenue, earnings, and free cash flow growth and consistency, and little to no debt, is an indication of some sort of competitive advantage. That, and when companies have a competitive advantage, that means that it's the sort of company that we want to buy. When companies have a lot of debt and they don't have revenue growth and consistency, those are the sort of companies that we want to avoid, almost always. The third thing that we want to avoid, almost always, is going to be companies with low returns on equity and returns on invested capital. And that is going to occur with companies that don't have some sort of competitive advantage. So if we look at a company like this West Fraser Timber, I'll do it here for you on Y charts, and so we can look further back. What we can do here is we can look at its return on invested capital, for example, and we can see that it's very volatile. It's very volatile, and it's not very high. If we look at the historical tendency, you know, it's averaging around maybe 10% over the last 10 years or so. Right, so that is an indication of a company that doesn't have some sort of competitive advantage. We're only looking to buy companies with competitive advantages. If we compare this to something like I was saying, Meta, which does have a competitive advantage, we can see what the difference looks like. Look at the difference, right? Sustainably high returns on invested capital is an indication of a wonderful business, okay? So just using those three screens there will eliminate about 99% of the companies. So the companies that we don't want are companies that have a lot of debt, don't have revenue and earnings consistency and growth and free cash flow consistency and growth, and don't deliver high returns on invested capital. Those are the companies, no way. We're not investing in them. They're too cyclical, they're hard to predict, we can't be certain of the future earnings stream, so we just eliminate them off the bat. So the sort of companies that we don't want are the companies that don't have a competitive advantage, and the easiest way to identify that is revenue, earnings, and free cash flow consistency and growth, as well as little to no debt, as well as high and consistent returns on invested capital. So if you find companies like that meet those three criteria, you're talking about a universe of stocks that has really, really been narrowed down to the best companies out there, which are the ones that we're looking to invest in. So avoid companies with a lot of debt, avoid companies that don't deliver high returns on invested capital consistently, and avoid companies that don't have revenue, earnings, and free cash flow growth and consistency. If you do that, you're on the right track to being a great modern value investor. Thank you for tuning in.